When you apply for a mortgage, your lender is required by law to give you a document called a loan estimate within 3 business days. It's a 3-page form that lays out everything about your loan, your interest rate, your monthly payment, and all of your closing costs in a standardized form designed to make easy to compare lenders. Most first-time buyers glance at it and set it aside. That's a mistake that can cost you thousands of dollars. My name is Robert Porto and I'm a home loan advisor. My team and I have helped hundreds of families across the nation navigate the home buying process while making it stress-free. Today, we're going to walk you through the loan estimate section by section so you know exactly what you're looking at and, most importantly, what you actually have the power to negotiate. Because here's the thing most homebuyers don't realize. There's really only one section on the loan estimate where you have a meaningful control over the costs. And if you don't know what that section is, you're leaving money on the table. Let's get into it. What is a loan estimate and why does it exist? The loan estimate, or sometimes called the LE, is a standardized 3-page document that every mortgage lender in the country is required to provide within 3 business days of receiving a loan application. The key word here is standardized. Every lender uses the same exact form, which makes it easier to compare offers side by side. Now, before the loan estimate existed, lenders used their own proprietary forms, which made comparing costs between lenders confusing and often misleading. The loan estimate was created as part of the Consumer Financial Protection Bureau Know Before You Owe initiative to give borrowers a clear and consistent picture of what they're getting themselves into before they commit. Now, here's something that's important to understand right from the start. The loan estimate is not a commitment from the lender. It's an estimate. The final numbers will appear on your closing disclosure, which you'll receive at least 3 business days before closing. Some costs can change between the loan estimate and the closing disclosures. Others are legally required to stay the same or within a tight tolerance. We're going to cover which is which as we go through each section. Page 1, the big picture. The first page of the loan estimate gives you the high-level summary of your loan. At the top, you'll see basic information such as your name, the property address, the sale price, and the loan amount. Below that is the loan terms box, which covers the most critical numbers. Your loan amount, how much you're borrowing, your interest rate, the rate used to calculate your monthly payment. Check whether there's a checkbox marked can increase after closing on a fixed rate loan. This box should not be checked. Your monthly principal and interest payment, this is just a loan repayment portion, not your full PITI payment. Prepayment penalty, most modern loans don't have these, but make sure that no is checked. Balloon payment, again, most standard loans do not have these, so make sure it also says no. Below the loan terms box is a projected payment section, which breaks down your estimated total monthly payment, including principal, interest, estimated taxes and insurance, and mortgage insurance if applicable. This is the closest thing to your real monthly payment that you'll see on this page. And it's a number that you should be budgeting around. Page 1, closing costs overview. At the bottom of the page, you'll see the closing costs and the cash to close summary. Closing costs is the total of all fees and expenses associated with getting your loan and completing the purchase. Cash to close is the total amount you need to bring to the closing table. That includes your down payment plus closing costs minus any credits that you may be receiving. These 2 numbers are important, but they're just a summary. The details behind them is on page 2, and that's where the real analysis happens. Page 2 is the most important page of the loan estimate, and the one that most buyers spend the least time on. This is the most important section of the entire loan estimate, so pay attention. Section A is where your lender lists all of the fees they are charging you directly to make the loan. Things like origination fees, underwriting fees, processing fees, and discount points, they're all in here. And here's a critical point. Section A is the only section where you have real negotiating power. These are your lender's own charges. We set them, so we can change them. And because you're comparing loan estimates from multiple lenders, this is exactly where you look to see who's charging more and who might be willing to come down. When you're comparing lenders, Section A is the first place to look. 2 lenders might quote you the exact same rate, but have very different Section A totals. You see, one might charge $3,000 in origination fees, while another charges $800. That difference comes straight out of your pocket. Discount points also live in Section A. 1 point equals 1% of your loan amount. So on a $400,000 loan, that's $4,000. Points are an upfront fee you pay to buy the rate down. If a lender is quoting you a lower rate but charges you points, make sure you're comparing apples to apples. Ask for a quote with 0 points so you can see the true rate that the lender is offering before any buy downs. Section B, services you cannot shop for. Section B lists fees for third-party services that your lender selects. Things like the appraisal fee, credit report fee, and flood determination. You cannot choose a provider for these services, and you generally cannot negotiate them. What you see is what you pay. Section C, services you can shop for. Section C covers third-party services where you do have the right to choose your own provider. Things like title insurance, settlement services, and pest inspections. Your lender may provide a list of approved providers, but you're not required to use them. Shopping around for title insurance in particular can sometimes save you a few $100s. Sections E, F, and G, taxes, prepaids, and escrow setup. These sections cover prepaid interest, your homeowner's insurance premium, and property taxes, and also the initial funding of your escrow account. Here's the thing to understand about these sections. You have virtually no control over these numbers. Property taxes are set by your local government. Insurance premiums are set by your insurer. Prepaid interest is determined by your closing date and your loan amount. You see, these numbers will be roughly the same no matter which lender you use. This is why the comparison between lenders should always focus on Section A. Everything else is either fixed by third parties or only have minimal impact. Quick pause. If this is the first time anyone has ever walked you through what's actually inside of a loan estimate, this channel was made for you. We post new videos every week breaking down the mortgage and home buying process in plain English for first-time buyers. So hit that subscribe button so you don't miss a thing. All right, let's get back into it. Page 2, the right side, loan comparisons. On the right side of page 2, you'll find 3 comparison columns: your loan at closing, at year 5, and the APR. This section is called the comparisons box, and it's incredibly useful when you're shopping multiple lenders. The APR, annual percentage rate, takes your interest rate and factors in most of the lender fees from Section A, expressing the true cost of the loan in a single annual percentage. This is why APR is almost always slightly higher than your interest rate. When comparing lenders, looking at the APR side by side is one of the quickest ways to see which offer is actually less expensive when you factor in fees. The total interest percentage, or TIP, shows you the total amount of interest you'll pay over the life of the loan as a percentage of the loan amount. It's a sobering number for most first-time buyers, but an important one to see clearly. Page 3 of the loan estimate contains additional important information that buyers often skip entirely. The comparison sections at the top summarizes your APR and total interest, which we just covered. The other considerations section covers important details like whether your loan can be assumed by a future buyer, whether there are any prepayment penalties, and whether the lender intends to service your loan or transfer it to another company after closing. Most loans get sold or transferred. This doesn't change your terms, but it means that the company you send your payment to may not be the same company you apply with. The confirm receipt section at the bottom is where you sign to acknowledge you received a loan estimate. Now, signing this does not obligate you to proceed with this lender. It's simply an acknowledgement of receipt. How to use a loan estimate to compare lenders. Now that you understand what's inside the loan estimate, here's exactly how to use it to compare lenders. Step 1, get the loan estimate from at least 2 or 3 lenders on the same day or as close together as possible. Rate markets move daily, so comparing estimates from different weeks isn't really true apples to apples comparison. Step 2, go straight to Section A on page 2 of each estimate. Add up the total origination charges from each lender. This is a number that varies most between lenders and the number you have the most power to negotiate. Step 3, compare the interest rate and APRs. Remember that a lower rate with higher Section A fees might be more expensive overall than a slightly higher rate with low fees. The APR helps you account for both. Step 4, look at the cash to close on page 1. This tells you how much you need to bring to the table. If one lender has a lower Section A but a higher cash to close, dig into why. There may be less seller credits assumed or a different down payment structure. Step 5, if you find a lender you prefer but another lender has lower fees, bring it up. You can show a lender a competitor's loan estimate and ask if they can match it or beat it. Many will. This is negotiation and it is completely normal. Recap and next steps. Let's bring it all together. The loan estimate is a 3-page standardized document your lender must provide within 3 business days of your application. Now, here's what to remember. 1, page 1 gives you the big picture: your loan terms, monthly payment estimate, and cash to close summary. 2, page 2 is where every cost is itemized and its most important page. 3, section A on page 2 is the only section you truly control. These are your lender's charges and they're negotiable. 4, sections B, E, F, and G are driven by third parties, appraisers, the government, and your insurer. They will be roughly the same no matter which lender you choose. Do not waste energy comparing these between lenders. 5, section C gives you the right to shop for your own title and settlement provider, which can sometimes save you a few $100s. 6, compare APRs across lenders to get the truest apples to apples pictures of total loan costs, including fees. 7, get estimates from at least 2 to 3 lenders. Compare section A first, and don't be afraid to negotiate using competitors' loan estimates as leverage. The loan estimate exists to give you power as a consumer. Most first-time buyers don't use that power because they don't understand the document, but now you do. Drop a comment below. Have you received a loan estimate yet, or are you still in the early stages of your search? I read every comment and I'm happy to help you work through what you're seeing. And if you haven't subscribed yet, we post every week to help first-time buyers like you make confident, informed decisions. See you in the next one.